Irmawati. I'm from Ekuitas School of Business, study program Bachelor Accounting D. Here I will try to present about the book that I have entitled Islamic Banking, How to Manage Risk and Improve Profitability from Emir Mohamed Tiby. Chapter 1, Introduction to Islamic Banking. A better understanding of the nature of risk in Islamic banking is crucial in setting solid and sound regulatory framework. There are four major factors that affect the risk in Islamic banks and make it different than conventional banks. First, the Islamic Bank Basic Foundation, which set its priorities as the promotion of fairness in transactions and the prevention of an exploitative relationship. Second, the nature of the relationship between the bank and the customers. Islamic banks' mode of financial are mainly asset-backed, which involve a great deal of contract between the two parties. Third, the profit and loss sharing arrangement between the bank and the customer on both sides of the balance sheet, which represent unique risk characteristics. Fourth, the liquidity contraction that face Islamic banks as they are unable to borrow in the market, as well as the very limited scope of their secondary market and the absence of the lender of fast, last response option. Chapter 2, History and Development of Islamic Banking. The root of Islamic bank goes back to the early days of Islam, yet its real birth can be attributed to the reform period that started in the late 19th centuries and early 20th centuries by pioneer Islamic thinkers and reformers. The development of Islamic bank can be divided into four periods starting from 1965 until the present. The purpose of part 1 is to discuss the origins of Islamic banking. It is important to understand the Islamic banking have solid, traceable roots and that they are not just a passing financial trend. It is also important to understand the major fundamentals and principles that form the basic foundation and govern Islamic banks. The fact that Islamic banks are set on a different foundation than a conventional banks expose Islamic bank to a different set of risks during their course of business. Therefore, part 2 will be decided to understanding the nature of risk in Islamic banks and how it differs from the conventional bank. Chapter 3, The Nature of Risk in Islamic Banking. Maintaining Profit Equalization. Reserve or PER and Investment Risk Reserve or ERR are the two risk mitigation techniques that are globally accepted. Operational risk in Islamic bank can be classified into four categories. 1. Operational risks that are similar to conventional bank, which include all types of risk. Misconduct, inadequate internal control system, and so forth. 2. Risk relates to the asset-based and contractual nature of the financial instrument used by Islamic banks. 3. The Sharia compliance risk, which consists of risk relation to potential non-compliance with Sharia rules and principles in the bank. 4. Legal risk, which arises primarily out of uncertainty in interpreting and enforcing contracts that comply with Sharia. Chapter 4, The Interest Risk in Islamic Banking Instrument. Sharia compliant products on both sides of the balance sheet carry different types of risk than the conventional counterparty. The unique nature of risk inherent in the Sharia compliant product arises due to three main factors. 1. The assets-backed nature of the Sharia finance instrument, as banks need to have actual possession of the assets. 2. The profit and loss sharing concept in the Musarakoh contracts. 3. The profit sharing and loss bearing concept in the Mudarabah contracts. 4. In both sides the balance sheet. Chapter 5. Operational risk in Islamic banking. In this chapter, we focus on three types of operational risk. 1. The risk related to non-compliance with Sharia principles. 2. The risk associated with the IIFS fiduciary responsibilities toward all fund providers. And 3. Legal risk. Sharia non-compliance risk is unique and significant in Islamic banking, as it leads to loss of confidence in the bank and the whole system on the three parts of the depositors. This in turn leads to withdrawal of funds by depositors, loss of income, and repossession risk, which threaten the overall business. Fiduciary and legal risks are significant, as well we'll see later in this chapter, due to the premature stage of the Islamic banking system. For the first, non-compliance with Sharia. There are two types of risks associated with Sharia. 1. The risk that arises from the different interpretation of Sharia rules in the different jurisdictions. The risk in the result of the existence of different Sharia supervisory boards, which leads to non-standard of practice, financial reporting, auditing, and accounting principles across the board. 2. The IIFS failure to comply with Sharia rules and principles, or which is our concern in these chapters. In extreme cases, the IIFS is exposed to reputational and insolvency risk as customers lose confidence and trust and will consequently withdraw their funds and cancel their contract with the bank. Second, fiduciary risk. Fiduciary risk is directly related to the unique relationship between IIFS and the investment account holders, which is based on a profit and loss sharing concept. The risk may arise when investing current account funds in a high-risk activity or mismanagement of those funds. Third, legal risk. The legal risk, which is significant because of the premature stage on both the Islamic banking system and the Islamic commercial law that is derived from the Islamic law Sharia. Chapter 6. The Islamic Capital Market. Capital market in the Islamic financial system has developed at a slower pace compared to the overall banking system. There are three main reasons for this. 1. The limited scope of the function of Islamic banks until recent times. Islamic banks were heavily dependent of deposit in their fund mobilization on short-term finance in their fund utilization function. 2. The lack of clear Sharia guidance in this area and the lack of Sharia scholars with a strong and solid financial background. 3. The ambiguous legal framework with relation to Sharia transaction. Thank you for your attention. See you later. Bye-bye.